Growth stocks on the other side, value is kind of old but cheap, which sounds awful to say, but that's kind of how it works. It's an established stock that's at a discount. Discount could be called cheap. We just use simple terms here. Growth stocks are the opposite. They are potentially startups or young people. They could do really well. They could become the next established company. More than not, they don't. So growth stocks, think of it like a growth. It's got a lot of potential, but it could not work out. So a growth stock may be doing any or all of these things, including investing in new products. Like if you think of Apple, for example, when they were doing the iPod, the music revolution, there were CD players, there was Walkman, there was all those sort of things. The iPod was a revolutionary product that changed the marketplace. And of course, the stock did quite well. The company did well too. Then they revolutionized the telephone with the iPhone. They revolutionized later the tablets with the iPad, etc. So Apple, back then at least, was a growth stock investing in and designing, creating, and launching new products, new projects, and it was fun, cool, and a lot of the investors made money off of that. Maybe they're generating lots of revenue and holding on to it for expansions. So they've got sales revenue, they're keeping it. And the problem with these, to kind of give they want to raise revenue, they don't necessarily give a dividend. So if you own a piece of this untested, unproven company, they may not give you a dividend. The ownership and the appreciation of these share prices, that's what you get. You don't get a dividend because they want to take that money, instead of thanking all their investors or sharing the wealth, they keep it for themselves. So they can expand, hire new employees, build new plants, do more marketing, design new products. So they're keeping the money in themselves. So hopefully you'll hit a home run, as we call it, and make a lot of money off the pieces of the company itself, not so much dividends. Sometimes we'll have what's called a competitive advantage, like a patent. So a drug company has a patent on whatever the solution that treats headaches, that treats cancer, that treats whatever the condition is. They'll have a patent that only they can use to develop that drug, or an iPad, or whatever the case you want to say for a technology company especially. They are usually expanding, they're growing, which is why it's called a growth stock, and potentially a breakthrough new product, again, going back to the examples, like an iPad or the iPod back in the day. Now we take it for granted, but back then there wasn't an iPod. Netflix, an example there really wasn't a really easy way to get movies just by clicking a button. So there was stores that would go and get a movie at the store, take it home, put it in DVD, etc. And the online world it was available, but it wasn't cool or easy. Netflix made it to about $8 per month to get online streaming. That revolutionized the business, and now we have Amazon, other competitors, Hulu, and all those things, but Netflix was a pioneer in a breakthrough new product. At that time, it was a growth stock. Great to own if it succeeds. If that product works, the marketplace accepts it, wonderful, you make money. If not, not fun. You can lose everything in terms of your investment. That doesn't usually happen, but you can lose a lot of money if you pick the wrong growth stock. So it really is boom or bust. Apple, Netflix, etc. So this is one that just busted.